Hello, everyone. I'm Fyruz Khan, and today, brand new class. I'm back with Business Studies Edexcel. Okay. So, very interesting chapter, as you can see from the cover. And we'll wait for our students to join. In the meantime, you can like our page on Facebook, Fyruz Education Services. You can also subscribe to our YouTube channel, Fyruz Education Services. Again, we have lots of IELTS videos and tutorials. We're uploading. We're constantly uploading on our YouTube channel. Even all the business studies classes will also be there. So yeah, you can also send me friend request if you want, because all the channels are live telecasted on my page as well. So yeah, there are a few students who's joined. Zavir is here. Yes, I hope Rehnuma is also here, and we will start. So today we'll talk about something which is very important and dear to everyone. Is this right? Money. So it's a 500 taka note, and on the slides you can see it's dollars. So this is required by everyone. Everybody needs this money. You work because of money. You want a job because of money. You want to do business because of money, because of profit. And we need money for a wide variety of reasons. We need money because if we want to buy something, if we want to pay wages, if we want to pay our salary, and the need is endless. Okay. Um, so that's so this is why we need money. So in I mean, for example, if you want to start a business, we need money because you want to buy materials. Now, if you want to start a restaurant, which we've talked about in the last class, you need tables, you need chairs, you need kitchen equipments, you need stove, and there are so many things that you need. Yes, you need a premises, you need a place for the restaurant. Okay, and you need money for many different things, to buy something, to pay wages, to pay salary, to pay fuel for the car, so many reasons. And it's a continuous activity, it's a non-stop activity, and you require money um, in different stages, in different phases. You may also need extra money. Okay, so finance is required in businesses in many different cases. When you start up a business, you need to buy machines, equipments, you need to hire a place. It can be an office space, it can be an industrial space, and it is a continuous activity. Okay, and it goes on, and later on, extra money will be needed. And this is the reason why you need to think about where is the money going to come from. Now, money can come from two places. These are the two places. Okay, internal source of finance, external source of finance. Now, internal source of finance means the money which comes from the business itself, the money which is present inside the business. And external means you borrow money from outside, you borrow money from other parties. And the examples are given. The internal source of money can be owner's capital. For example, let's say I'm the co-founder of FES and I have my own savings, own money. Yes, so that is owner's funds or owner's capital. That is an internal finance. The money is coming from the business. And make sure you listen to this carefully. If you don't understand this, you will not be able to understand the whole chapter. Okay, so the money is coming from the entrepreneur. So it is within the business. Retained profit means the profit that you've made in the business after paying your tax, after paying your shareholders. That's your retained profit. Now that is also internal source of finance. Sale of assets. For example, let's say this is an extra laptop that I have. Okay. And I need some money for my business and I don't need this extra laptop. So let me sell it off. If I sell it off, I'll get, let's say, 40,000 taka. And with that money, I can do whatever I want. I can pay wages, I can pay rents, I can pay bills, I can invest on something else. Okay, so these are all internal sources of finance. Owner's capital, owner's money. Okay, I'm the founder of FES, Fyruz Education Services. I have my own savings. Let's say this is my own savings. So this is my own capital, my money. It's internal source of finance. Retained profit, profit that is made, again, the profit that is made by the business. Let's say the profit made by the business for today's month is 500 taka. I've paid my tax, I've paid my shareholders, and this is my profit. So this is also within the business, yes? Okay. And this is an extra asset that we have. If we sell it, we'll get some money that also comes from the business itself. Now let's talk about external source, which is very easy. If you borrow money from the bank, let's say EBL or Dhaka Bank or AB Bank or Citibank, Standard Chartered Bank, that's an external source of finance because you're getting the money from outside, from out. Investors, let's say somebody from outside who wants to invest in your business. So that is external sources of finance. Overdraft, banks give you overdraft, right? What is overdraft? Overdraft means you can withdraw more money than you have. Let's say in my bank, I have 500 taka, but I need 800 taka. So the bank will give me 800 taka. So it's minus 300 and I can pay it later. Okay, of course, there will be a surcharge. Of course, there will be interest rate. So what is the main difference between internal and external? Now, this chapter only looks at internal source of finance, but I wanted to talk about external, otherwise you will not understand the difference. So internal source of finance comes within the business, and these three are examples. External source of finance comes from outside, and these are the examples. Now, if it's your own money, if it comes within the business, if it's internal, it has no cost or no interest. You don't have to pay interest. So if I have 500 taka profit, I don't need to pay 5% or 3% interest on this or 9% because it's my own money. I have made profit. I'm not taking from someone else. But if I take this money from the bank, there will be a surcharge. There will be an additional cost. Okay, 500 টাকার জন্য 9% interest দিতে হবে. Okay, so that has a cost. Then it decreases your profit. So that's internal and external source of finance. For today's chapter, we will only look at internal source of finance. Okay, very easy. So yeah, Tanvir Islam bank loan external. Exactly, I agree with you. Great. Let's go ahead. We have a lot of viewers. This is a car, a very nice car, a Dodge car. Now, if your business buys this car, this can be called capital expenditure. Why capital expenditure? Because you're investing on equipment, on machine. One more reason is that you can use this car many times, multiple times. Do you buy cars every day? No. Probably you will buy cars once in every 5 years, once in every 10 years, or sometimes once in 15 or 20 years. So that's a capital expenditure. Okay, that can be used over and over again. And then it becomes an asset of the company. Of course, there will be depreciation every year, but this is a capital expenditure. If you invest on machines, on cars, on laptops, okay, so these are capital expenditure that can be used over and over again and again, and it stays with the company for a long period of time. But now let's say your company does not have any petrol and you go to a petrol station to refuel your tank. So when you put fuel in your tank or petrol in your tank, that's called revenue expenditure. Okay, revenue expenditure means which is used every day, which helps to run your business every day. We've talked about it, right? Something like working capital. Okay, so there are two kinds of expenditure in a business. Capital expenditure, you buy machines, it's one-off cost mostly, and they will last you more than 1 year. So that's capital expenditure. And you need things like petrol, fuel every day that helps to keep your business running, and that is known as revenue expenditure. Yeah. So capital expenditure is spending on items that may be used over and over again. For example, a company vehicle, a cutting machine. And revenue expenditure is, it refers to payments, goods, and services that have either already been consumed or will be very soon, like raw materials, wages, fuel. These are all revenue expenditure, which helps you to run the business every day. It's a continuous expenditure. Okay, working capital every day that is required for the business to operate. Okay, if I don't put fuel in my company cars, I cannot run my business. Yes, so that is revenue expenditure. If you have any questions, please do not hesitate to put it down on the comment section. People are responding, which is good. Uh, just type on our page, Fyruz Education Services. You can see our video from Fyruz Khan, but if you comment, I may not see it because there's a problem with the system and I'm trying to fix it. So let's go ahead. Great. Um, so one main source that we have talked about here is one of the main source of internal capital is owner's capital. If I've started FES, I have some money, right? And that is owner's capital. It's my own personal resources. It's my own personal savings. Probably I have worked before. I've worked 5 years, 10 years. I've saved some money. Uh, uh, you know, I have saved some money to invest in my business. So that is my personal saving. And most of the entrepreneurs, when they start their business, they use their personal savings just like me. I had some personal savings and I used it on my business. Because when you start a business, there are a lot of people who will not trust you. Even banks will not give you loan. Okay? Um, because you don't have any trading records, you're new. That's why. And mostly you will find this in terms of sole trader partnerships. They will use their own capital, own money. Sometimes, let's say the business is in a big problem, there's a shortage of cash, and the owner will sell their properties or items and put money um, in the business, and that is owner's capital. So one big source of internal finance is owner's money, founder's money. Okay, so you can invest in your business to make a new product, or if there's a problem, or if you want to invest in a fresh way, if you want to buy shares. So that is a huge part of internal source of finance, the money coming from the owners. Okay, so that's number one. Number two, the profit that you make in the business, retained profit. You've paid your tax. Now the money that is left is your retained profit. With that money, you can invest in the business. You can start making new products. Okay, you can invest on research and development. You can hire better people, or you can just keep the money in the bank so that they can get interest. You can also do that. Okay, so that is uh, retained profit. But however, if you use retained profit, you may not be able to use that money for your own lifestyle, for your own let's say personal holiday. Your family will not be able to to have fun with that money, because retained profit is basically the owner's profit. So you can use it to develop products, on research and development, or on the company itself, for anything that you want. Or retained profit means it's owner's money as well, because you've made the profit and you have the complete authority to use it. So you can use that money for your own purpose, on your family, to fund your lifestyle. But if you use retained profit on business, there will be opportunity cost. You will not be able to spend that money on yourself. Most of the businesses keep their retained profit, and they invest on their businesses. They invest on their business. They try to make new products. They do research and development. They do all sorts of things. Okay, so that's that. If you have any questions, please do not hesitate to comment, to put your comments on the comment section. So that's retained profit, okay? And retained profit is a very flexible source, because see, if you're talking about bank loan, the process of bank loan is very difficult. You need to contact the bank, you need to write the form, you need to give them all the information. They would want a lot of documents from you, your bank statement, how have you been doing in the past few years. They'll be checking all your details, and then they will give you bank loan. And it takes some time. Sometimes it can take 1 month, 2 months, 3 months. So, but retained profit is the profit that is done by the business. It'll be readily available with you, and you can use it anytime you want. Okay, and you don't have to pay any interest. So there you go. But then again, not everybody has retained profit. New businesses, let's say, which has just started for 2, 3, 4 years, they may not have retained profit because they've just started. Big businesses is more likely to have profit. Okay, not new businesses. So keep that in mind. Not everyone can use or has the access to retain profit. Okay. Then sale of assets. I told you, right? So, for example, I have a very good example here. Let's say you have a piece of land and an old car that you don't require, that you don't use, and somehow you need some money in your business to pay off your rents, to pay off your wages, or you want to invest somewhere else. What you can do is you can sell this piece of land and you can sell your car if you don't require it. Research properly, take decisions properly. If you don't need the land, if you don't need the car, then only sell it. If you require it, if it's a very good asset of yours, then don't sell it. But if you think that, we are not going to use this asset, it's just there, so just sell it. So if you sell it, let's say you get 50 lakhs, okay? And with that money, you can do so many things. 50 lakhs, you can pay off your debts, you can pay off your wages, you can pay off your rent, you can invest in some company, you can invest in some product, or you can just keep it in the bank. Okay, so you can sell your assets. That's what. I can sell my extra laptop because I don't use it. So I can sell it, get that money, and use it somewhere else. Okay, so think about that, selling your assets. Any questions? Please do not hesitate. Do not hesitate. Let me see. So yeah, there you go. Ridwanur Rahman, thank you for the appreciation. I try my best. All these slides and everything is personally made by me, and I make it every day in the morning. I spend a lot of time. Thank you. Let's go ahead. Then we have, this is a very interesting concept that you must know. Sale and leaseback. So let me tell you a story. It's a real story, by the way. So this is HSBC Bank headquarters in New York. In 2007, HSBC needed a lot of money. Okay, they needed a lot of money because they wanted to invest somewhere. Okay, so what they did, this is their own place. This is their own place. They own the land. They own the building. They sold it. They sold that own place. They sold that building to IDB. IDB is a Jewish conglomerate. They sold it for $1.3 billion. It's an 865,000 square feet. Amar basha mato 2,000 square feet. This is 865,000 square feet. It was a massive place. It was a massive, let's say, a commercial complex. And they sold it to IDB for $1.3 billion. Now the question is, Amake, you can ask me that, okay, they've sold their headquarters, they've sold their land, they've sold the building, but where are they going to go now? What they did is they leased it back. Okay, they sold it and they took it for rent again. okay, from IDB. They paid $43.5 million for 20 years. So they sold their property, they sold their land for $1.3 billion. Now they have a lot of money, a lot of cash. With that cash, they can do whatever they want. And they leased it back from IDB, saying that we want to rent this place from you. And they gave them $43.5 million. নিজের জিনিস বেচে তাদের থেকেই আবার ওটা রেন্টে নিল। So that is known as sale and leaseback. Okay, so you can sell your property if you really require a lot of money. So HSBC sold their headquarters to IDB for $1.3 billion, and then they leased back the property from them for $43.5 million for 20 years. Okay, so in this way, now they have a lot of cash. And paying for the lease of $43.5 million is not so much because they have this $1.3 billion of cash. So, yeah, there you go, right? If you have any questions, please let us know. So this, you can also do this sale and lease back, right? And there is one more example here. Like India, they sold Air India. They sold 9 of its Dreamliner aircraft for 6,000 crore rupees. Okay, and then they leased it back. Okay, so one more example is given here. They sold their planes and they rented the plane again. Okay, so in this way they had access to 6,000 crore rupees, and they leased it back because in order to lease them, it's not going to take so much of money, right? So yes, so we've talked about again. I want you to look at there are 3 sources of internal finance. We've talked about owner's capital. We've talked about retained profit. We've talked about sale of assets. We've also talked about sale and lease back, where you sell and lease it again. Okay. The main advantage is that it has no cost or interest. External source of finance, it has some kind of interest. Okay. Let's go ahead. If you have any questions, please put it down on the comment section, and please keep it very respectful, because we have a very big learning community here. So we will have questions regarding the chapter only. Thank you. So what are the advantages of internal finance? The first advantage is, if you look here, the capital is available immediately. As I told you, for bank loan, you have to apply for a bank loan. You have to wait for a month or 2 months. There is a big process. It's very bureaucratic. But for internal finance, you don't have to do it. You made 500 taka profit, and it's there in your bank, and you can withdraw the money whenever you want, and you can use it whenever you want. Okay? Internal finance is also cheap. There are no interest payment, because it's your money, it's your profit. Why would you have any interest rate on your money? Okay. Then you don't have any credit checks as well. What do you mean by credit checks? So again, okay, Zavir, however, sale of asset has a drawback. Okay, for example, suddenly you or someone becomes seriously ill, such as cancer. It'll be difficult to pay bill. Sale of asset. Yeah, you are saying it more in the personal sense. We'll come back to that, Zavir, and we'll talk about it. Yeah, you're correct. In a way, you're correct. Now, what does credit check means? Now, credit check means when you apply for a bank loan, let's say Zavir wants to apply for a bank loan. Now, if you go and apply for a bank loan, they will not give you the loan. They will do a credit check. They will do a background check. Okay, how is this person? Has he borrowed any money before or not? How is his background? How is his records? They will check your record. They will check your previous bank statement, previous dealings, previous borrowings. Okay, if it's good, if everything is fresh, then only you get approved for the loan. If you have a bad history, let's say you've taken a loan, you haven't paid back, you won't get a bank loan. You won't get a credit card. So before bank gives you a loan, they will do a credit check. Credit check means they will check your financial history. They will check your financial background. Okay, so that is credit check. Write it down. For example, when you apply to a university, they do some kind of background check. They look at your past results. Here, in this case, the bank will do a credit check. They will see if you had any previous loans, any previous defaults. Have you paid all the loans previously properly? They will check all those things. And if you have a impeccable record, a good record, then only you will get the bank loan. And there are no required for third parties. You don't need a bank. You don't need a financial institution. You don't need an insurance company. You don't need anything. Okay. So these are the four main advantages of internal finance. Okay. It's available immediately whenever you want. Second, it's cheap. There are no interest cost. Okay. There are no credit checks. Nobody will check your background, financial history. No. And there's no involvement of third parties. These are the advantages. Now, Zavir, let me read your question again. However, sale of asset has a drawback. Okay. For example, suddenly you or someone becomes seriously ill, such as cancer. It'll be difficult to pay. Okay, you're saying in terms of, it is like a backup, because if you sell your asset, it is like a backup. You can sell it later and use it, or the assets, let's say the value of assets may go up in the future. Then what do? You're correct. Even I don't like selling off assets. I keep everything. I keep whatever I have. I don't. But sometimes you have to in businesses. I have seen big businesses selling off their assets. There is a textile company that I know. Last year they had problems with the money, so they needed some money. They did not want to take a bank loan. So what they did was they had some land, spare land, and then they've never used that land, and that land was worth around 18 to 19 crores of taka. So it's a lot of money. So they sold those lands because they have never used it, and they got those money. With that money, they invested in something else. So, but sometimes in business, you need to sell your assets. Let's go ahead. Disadvantages. Internal finance can be limited. Profits are limited. I have 500 taka, but I cannot, I don't have the access to 1500 or 2000 taka, but the bank does. You may have access to 1 crore. Your profits is 1 crore, but what if you need 10 crores? So the finance is very limited. It's very small. Okay. And it's not sufficiently profitable. Okay. So banks can give you a lot of money, but in terms of profit, it's a very limited access. But then, very big companies, very, very big companies have a lot of money, like Apple, Reliance, Tata. They are different. But then internal finance is limited. Internal finance is very inflexible as well, because when you take a bank loan, sometimes interest rate increases, decreases. You can change the duration of time. You can reapply for the loan. You can extend the credit. You can do a lot of things with bank loans. You can transfer from one bank to the other. It is possible. But with internal finance, those things are not possible. Okay. Then the third part I'm going to explain you using this table. We have 2 examples. Let's look at example A. Let's say you have example A is internal finance. Internal finance is profits, company's own money, owner's own capital. And let's say you have 5 crores in the bank. Okay. Now on that 5 crores, you need to pay tax on it because it's your own money. You own that money. You have to pay tax on it. But if you use external finance, if that 5 crores is taken from a bank, if it's a bank loan, you may be exempted from the tax because, yes, you have taken the loan, but it's not your money yet. You're repaying it. It still does not belong to the company. So no taxes will be applied, or even if it's applied, it's reduced tax, or you may be exempted from it. Okay. So this is a very good example. You will see in Bangladesh, whenever everybody buys a car, they will take a loan. When I was growing up, my question was, you have money, but why are you taking a loan? Businessmen will not tell you. Let's say you have a nice car, okay, and you buy a car with cash, 40 lakhs. Let's say this car costs 40 lakhs, okay, and you buy it with cash. Now, when you buy it with cash, you're buying it with your own money. When you buy it with your own money, you have to pay your tax, right? Government will not take any excuse because you could afford to buy the car with your own cash, with your own profit, and that's why you can also afford to pay tax on it. But if you buy this beautiful white car, if you buy this beautiful white car with bank loan, let's say for 5 years, 40 lakhs, if you take 40 lakhs for 5 years, you don't have to pay tax on it, or you will be exempted from it because the money still does not belong to you. It belongs to the bank and you're repaying it. You will pay tax only after you've repaid the money. That's why a lot of businessmen, a lot of entrepreneurs, even if they have money, they will take loan from the bank because tax does not apply to loan money. Even if it applies, it's reduced. You can show it to the tax department. Oh, it's all borrowed money, right? So this is a trick. This is a technique that is used everywhere. No businessman does business with their own cash, own profit, because own profit is for emergency, rare situations. Okay? So if you take a loan from the bank, tax will not be there. So that's the third point. Okay? So if you use internal finance, you have to pay tax on it. But if you use external finance, you don't have to pay tax because it's borrowed from a bank, it's from an investor, it comes from a third party. Okay? It shows that you're still not capable of paying it, right? If you have any questions, please do not hesitate to comment down on the comment section. I'll take any of your questions. Okay. We've done this. We've done this. Let's see what else we have. Disadvantages. We have some more disadvantages. It's an opportunity cost. Let's say you have 50 lakhs of profit and you use that profit to make a new product, like let's say a new makeup or a new lipstick, right? But that's fine. That's good for the business. You are investing on new product. Investing on new product means you can make more profit in the future. You're extending your product category, which is excellent, which is great. But then your investors may be unhappy. They may be like, oh my God, you're burning our own cash and we may not be able to get our dividends, our profit. Because remember, investors are always motivated by short-term goals. Ora khali oder taka chabe. So when you use your own money, own profit, they will not be happy because there's a chance, there's a risk that they may not get their own dividends or profit for that year or for that month. So there will be a bit. I mean, there's an opportunity cost that either are you going to spend the money on new products, invest on them, or invest on the shareholders. If you invest on the product, the shareholders may be unhappy. And if you invest on shareholders, this opportunity of making new product may be lost. So in either ways, you're losing something. So think about which is more important to you. What is more of priority to you? So look at that, right? Great. We have finished this chapter successfully. 34 minutes. There are some definitions at the end. Please do have a look. I will email this chapter to you right now, all the students. Capital expenditure, internal finance, retained profit, sale and leaseback, revenue expenditure, right? I hope you've understood. If there's any questions, especially Zavir and Rehnuma, please do not forget to to knock me, to ping me, or we can have a call, right, if you want. So think about, if we just start from, okay, think about internal finance, okay? Internal finance are of three kinds: owner's capital, retained profit, sale of assets. Sale of assets can also be sale and lease back, okay? The main advantage is that it has no cost or interest. These are external finance. Problem with external finance is that it incurs interest rate. We've talked about this is a capital expenditure, this is a revenue expenditure, and we've talked about why do we need money, okay, and owner's capital is internal finance, retained profit is internal finance, and sale of assets is internal finance. We've talked about, you can sell your assets and get the money. You can sell your assets that you don't require, that you don't need, and use that money in your business. That's an important concept. You can also sell and lease back. I've given you an example of HSBC, where they sold their headquarters for $1.3 billion and leased it back from, again, IDB for $43.5 million for 20 years. Okay. Sale of assets. Okay. Again, I showed you the difference. We've talked about the advantages and disadvantages. Great. We will finish it here. And I've spoken about in details. I've spoken about, if you have internal finance or your own money or your own profit, there is tax attached to it. But if you borrow money from the bank, there is no tax, or you'll be exempted from tax, or you will have to pay reduced tax. This is a very important concept that Edexcel has mentioned. And I think it's very useful because this applies to real life. When I was studying business, these things were not there, but this is really, really great. Okay. Thank you very much. I will be back again. Enjoy your weekend. Do not forget to press the like button on our YouTube page. Like, share, subscribe our video. Like our Facebook page as well, Fyruz Education Services. We have a fantastic page. Every day we post a live video. And you can also send me a friend request because all the videos are also live telecasted on my page as well. Thank you very much. Have a good time, and I'll see you soon.